main focus point concerns this topic: 10 ETF strategies and how they work. Okay, and there are different ways to utilize ETFs, and ETFs are becoming more and more popular. Still, they have less assets than broader, mutual funds, but ETFs continue to gain market share, and it's important to understand how they fit. Okay, how they fit with the overarching goals that you might have. It's not just about throwing it into an index, right? Just buying the S&P. It's, for most people, that's too simplified of a way of looking at how to invest, because it's about risk tolerance, it's about exposure to the right type of inflation hedges, and many other factors. Okay. Now, the first strategy is simply buying and holding, right? Not doing too much and using ETFs as an alternative to most mutual funds because they tend to be lower fees. So if you're in a buy and hold approach, ETFs tend to be a better way to go than mutual funds. Then there's dollar cost averaging. And it's nice to have ETFs, especially over a mutual fund, because you can buy throughout the day, maybe when there's a big dip in the morning, things like that. And there's zero commissions, with pretty much all of these brokers now. There's no commissions to buy ETFs. And so when you can dollar cost average every month or every week, however you're going to do it, you likely are buying some at lower prices, because naturally you'll be buying during pullbacks throughout any given year. And that is a good way to get invested if you're not sure on the timing or really how to get allocated. Okay. And then the next would be just broader asset allocation. Like I said, buying just the S&P or the NASDAQ is too simple for the vast majority of investors. And it's about creating the right mix of assets, stock exposure. Remember, ETFs can own stocks, bonds, commodities. There's all types of strategies that ETFs can deploy. So it's about utilizing those ETFs properly and knowing how to build an asset allocation. Okay. And then when you build that asset allocation, you can make adjustments. You can do something like a sector rotation. There's sector ETFs out there for 11 different market sectors. But what we do at KP Financial is we are focusing on the economic trends at the top level, looking at growth and inflation trends. And based on that, there are typically sectors or asset classes that you want to be over or underweight. And that's what we do. So using ETFs can be a quick way to execute that type of sector rotation strategy or asset allocation adjustment based on the underlying market environment. And then there's swing trading. So this is getting access to certain classes of investments, certain indices, certain sectors that might be breaking out and owning them for a short period of time. Now, the next one would be using leverage, using ETFs that create leverage. Now, typically leverage is used using some sort of derivatives, margin, etc. And that can be more complex for the average person. But if you use a leveraged ETF, that can be a good way to amplify returns over a short period of time. Now, the first thing you have to realize, though, is never hold these for an extended period of time. This is for swing trading. This is for short term. Hold it for a week, 2-3 weeks, probably max. Beyond that, you don't want to be holding these type of positions. Okay. So, but they can be utilized very, very selectively. And same with short selling, right? If the market's going down, you can utilize short ETFs and even inverse short ETFs in order to hedge on the downside. Now, once again, you don't want to hold, the market generally goes up. So you don't want to be holding short ETFs for extended periods of time, but they can be part of a tactical allocation shift. Okay. And then hedging mainly against inflation. So buying things like tips or commodities, those are good ways, commodity ETFs that are good ways to get broader exposure during higher levels of inflation. And then dividend investing is another one where you don't want to just go by the name of the ETF. You really want to understand the underlying equities that they're holding, but it can be a good way to avoid the deep dive into each of these names like we do for our clients. But if you just want to kind of keep it surface level, you can look at the underlying in general and make sure that it's not overweight companies that have a bunch of leverage and could have the dividend cut. That's one issue that you get with a lot of high dividend ETFs, is that it's completely ignoring the quality of the business or the quality of the balance sheet. And so dividend investing ETFs are generally good, but don't be chasing the yield per usual, right? Focus on the quality businesses. And then thematic ETFs, that's the last one. You're talking about those that get exposure to structural trends. You're thinking maybe green energy, cryptocurrency, emerging markets, certain technologies, robotics, etc., AI. And there are 300 thematic ETFs. So there's a lot out there. The warning here, though, is that if it's a popular theme, most likely it's not a good time to buy. Usually what happens is these thematic ETFs get launched, usually when there is a fervor around a particular subsector or theme, and those stocks are drastically overvalued. And then the market, it's like a dog, right? It gets distracted and it finds some other theme that looks interesting, and money gets pulled out of that old theme and into the new theme. And that old theme suddenly craters 50, 60%. So make sure you stay away, usually for those thematic ETFs.